Thanks, Lisa, and hello, everybody, again. My name's Peter Christie, Chairman and CEO of Activeport, and thanks for everybody for coming. Today, we're going to talk about capital and growth. The primary subject of the call is to talk people through our rights issue, so we'll do that first, and then we'll get on to some of the new projects that we've kicked off in the last month. Some very exciting announcements that we're putting out to the market this week and next. But to kick things off, let's talk about the rights issue, because that is obviously the subject of the minute. So rights issue, people would know that we went to the market in August to raise money. We delivered a profit in FY24, both an EBITDA profit and cash profit. So we were quite confident the share price was heading in the right direction. We went out to raise money. We raised enough. It was adequate. But then we signed up a couple of new projects which are quite resource intensive. And so we found ourselves in a position where we didn't quite have enough working capital to execute those projects well. And so since August, we doubled our effort to solve our working capital challenge. And we turned over a lot of rocks. We looked high and low for alternatives to going back to the market again. In that process, I think we were quite successful in probably solving our capital market challenge going forward, because we've accumulated some fantastic new partners along the way. We've got a new corporate advisor coming on board soon that has an absolute pedigree in managing corporate transactions, capital transactions for tech companies on the ASX. So we're very excited about that. We have new consultant work on our debt facilities, and we'll talk about that a little bit in a minute. We have our new partnership in Singapore to help us find new investors and new interest in the Asian markets, which I think is very, very important. And of course, we're supported well by Bridge Street, who have been with us since the beginning and are doing a fantastic job in supporting us through thick and thin. So I think going forward, we have a much stronger team around us to help us ensure that the business is fully funded. But short term, we need to bridge the gap that we have in working capital to be able to deliver the projects that are in front of us. And so we looked high and low. We didn't take the rights issue on without a lot of consideration and without looking at all the other options available to us, good and bad. To the extent, if I think about the bad options, if it barked in financial markets terminology, we gave it a pat. But none of those solutions were going to be good for us. They would have solved a short-term challenge, but they would have compromised our ability to raise money in the future if we had to do that. And so we decided that a rights issue was the best way forward. And stepping into that, my own personal stipulations were threefold. The first was that we didn't want to go back to the market and do a placement, your traditional 20% discount, and then a limited group of investors taking up the placement. We've done that twice, so I didn't want to do it again. And so the discount, the first rule of the three, was the discount had to be significant enough that it would attract enough investors that we would be one and done, that we would get this equity round done, and we would be fully funded into the foreseeable future. Hence the discount and the price point. The second rule was it had to be accessible to everybody. Placement is limited to a select few investors, and I'm not a big fan of that. And so if we were going to discount to the extent that we did, I needed to make sure that all the existing investors had equal access to it. And so a rights issue made the most sense given the size of the discount. So rule number one, significant discount to attract enough investors and to fill the round. Second rule was to make sure that everybody had equal access to those discounted shares. And then the third rule was to make sure that on a fully diluted basis, and given our target short-term market cap objective, the third rule was that the target share price had to be above 10 cents, above the existing option price. And so the rights issue is structured to achieve those three things. The rights issue is structured so that we can raise up to $5.3 million. And if we do take that full amount, the fully diluted number, including all the options that would be issued, we'll see our share price still capable of getting above 10 cents if we hit our short-term capital market cap targets. Now, the one thing I would say about the 5.3 million is that we don't need 5.3 million. We would be quite happy to take a significant half of that, in fact. But it's a rights issue, and so there is no stipulated minimum. Having said that, once we set the ratio, then there's definitely a maximum. So the maximum is 5.3, but we certainly don't need to take all of that. Second thing is it's renounceable. I've had quite a lot of debate about renounceable and unrenounceable rights issues with investors. I think the best thing I can suggest to people is that if they have a question around that, we can put you in touch with the manager of the round, and Michael can give you quite a detailed précis on the pros and cons of a renounceable versus unrenounceable, but nonetheless, this is a renounceable rights issue. The third thing, of course, it's fair for everybody, as I said. And the fourth thing is that it closes on the 1st of November. So we are possibly halfway, a third of the way through the process now. And so there's a very tight timeline to get this done for people that wish to participate. And so that's the history of the rights issue. If we close the rights issue to the extent that we need, then we will not have to go back to the market and do this again. We will be adequately funded to see all the new projects through. And so we're quite confident that this is the right approach. I'm happy that it's fair for everybody. And the amount of demand and support that we're seeing so far in this process has been quite promising. And so I'm very confident about the rights issue in total. People ask me about my own personal contribution. The answer to that is that I intend to take up my full allocation, working through paperwork to make sure that we can get that done right now. All things being equal, then I will take up my full allocation because I fully believe in the business, and I think this is a price too good to miss out on. And I hope, I can't speak for the other directors, but I hope that the other directors do the same thing. So let's talk about debt. We currently have some debt, and the reason I talk about debt here is because obviously we don't intend using any of the proceeds from the rights issue to retire debt or our long-term debt. We will be seeking a debt facility to replace our R&D lending that we've relied on for the last couple of years. People would have seen on our financial statements, our finance costs were significant. I think if we can structure a debt facility around our 2 future R&D receipts that we hope we will get, which will total more than $3 million. If we can structure a debt facility around that, I think it would be wise, would be beneficial for the shareholders. And it means we're not using equity rounds to retire debt. We're just replacing the debt that we will have as a residual, which totals a little bit under $2 million. We'll be able to replace that with a single facility that's larger than what we currently have. And that should see us funded through into the future quite adequately. I'm not a big fan of debt. I like to make sure that we don't compromise the integrity of the business by taking on too much. Nonetheless, it's a future facility that we're working through at the moment. We're going to take our time and make sure that we get the right facility with the right structure, the right terms that suits our business needs. We would be able to secure that debt against our future R&D claims, and so we know that we're not overextending the business. And we would only draw down on it as required and if required into the new year. And so we're working with a consultant in Sydney to help us put that together. And since we turned a profit, I think our conversation with debt providers has been quite promising because we're obviously able to take debt on and manage it adequately. And so I'm quite enthusiastic about this facility. But the main thing is to ensure that we're doing on better terms than the debt we currently have, to ensure our finance costs are reduced going into FY25. And so they're the 2 projects that we're working on around working capital for the business. The first, the rights issue. The second thing is the debt facility. And then the more positive discussion is around what are we going to do with that working capital. And so before I get into the projects, I'll just step back for the people that haven't seen our business and give a quick overview of what we're doing. Activeport is a software business that delivers software to the telco industry, primarily the data center industry. And then we have some vertical market solutions across cloud gaming and AI that are related to our telco customers. And so the business in FY25 is focused on using that software to generate revenue from two different streams. The first is the SaaS stream, where we're using our software as a service platform in Australia and New Zealand at the moment, and then expanding overseas as we grow. The second thing is selling our software as licenses to the telecommunications industry, which we've been very successful at, and we've got a raft of new projects in the telco sector as it's coming through. If I look at our SaaS implementation, we're building what we call our network ecosystem orchestration platform in Australia and New Zealand. On our software side, we call it network orchestration software. We license it to telcos and data center operators globally, and we're kicking off 4 new projects at the moment in that space. Our focus on the business from here is to generate recurring revenue. It's a comment I hear far and wide, is that people want to see Activeport deliver good, strong recurring revenue growth, and we intend doing that through all of our reporting through FY25. And the one thing I would say about these two business units is they're very high margin. Our software, because it's a license and because the telcos operate it themselves on their own network and their own premise, the margin for our software sales is above 92%. In our SaaS business, similarly, it's a low OPEX SaaS model because we are providing a network service, not compute and storage. And so our margins in the SaaS platform are 65 to 75% as well. So I think the combination of focusing on those two revenue streams, focusing down on generating recurring revenue growth at a very high margin, should see us to deliver some outstanding results in FY25. If we think about our target addressable market, across the telco industry, the data center industry, the cloud gaming industry, and the upcoming AI industry, our target addressable market across that is $4 trillion. Our revenue per user for our software license business, we price the product on what we call a point of presence, and telcos have between 50 and 5,000 points of presence. Our base revenue for the software is $2,250 per point of presence. And so we've got significant opportunity to generate multiple millions of dollars of license revenue per customer. Our contracts with our telcos are 5 years plus. On our SaaS platform, it's different. On our SaaS platform, it's month to month and pay as you go. And we can talk about the difference between those two revenue streams. But the telco software revenue stream is complex to achieve, but once we achieved it, those telcos are really committed to using our products for 25 years plus. In the SaaS business, it's faster conversion of a new customer to cash, which is great because it's more predictable. But the ARPU is lower and the margin is a little bit lower as well. And so the combination of those two revenue streams makes it a very attractive business for an investor. And so if we think about our revenue per customer, especially in the telco and data center sector, it's north of $1 million per year per customer, which is quite significant in the software industry. And of course, across those four different markets that make up that $4 trillion target addressable market, the tier 1 telco industry, the data center industry, cloud gaming business, and the AI industry. Now, if we look at a couple of new projects that we need to be able to resource in the short term, one across in the software business and one in the SaaS business, the new Asia telco rollout that we've started in Singapore and Malaysia in the last month is underway. We're running field trials at the moment across those two cities. And when you think about the significance of that, building a self-service network capability for a major tier 1 telco in Southeast Asia that's connecting the two major data center hubs in Asia across Johor in Malaysia and Singapore is a very, very high traffic region. If we get it right, we've got the opportunity to generate a lot of revenue from that network alone. But then once that's successful in November, we will start the rollout across Bangkok, Hong Kong, and Sydney, and from then expand out to another 9 cities around the world. And so this particular project we're very excited about because it is with a tier 1 telco in Southeast Asia that everybody knows. It is groundbreaking in the technical deployment. It should be significant in delivering new revenue for the telco that's implementing this. And it would be a fantastic reference site for us to be able to deliver more of this in other parts of the world. So this rollout is underway, and we'll be able to make announcements about the success of that and what it means for the telco industry before the end of the year. So we're very excited about that. In the SaaS space, in SaaS, we have a portal called Global Edge. It's our network ecosystem orchestration solution. The most exciting thing in our SaaS space is the announcement that was made yesterday at the Comms Day, trade show in Melbourne, is the relationship between our Global Edge SaaS platform and FibreconX. And I'll just talk about FibreconX for a minute. To highlight the significance of this project, if you think about the fibre networks in Australia, TPG, Vocus, Telstra, Optus are the major providers of fibre in the ground through the capital cities and to the data centres in the country. FibreconX is a business formed by a team of industry veterans. Mark Rafferty, you see on the screen there, built the TPG fibre network. He has surrounded himself with a fantastic team. What they're doing is building a brand new fibre network in Australia. The old networks have been in the ground for 30 years. They've been spliced and diced and cut and rerouted over the years. They work, but they're not efficient. And so FibreconX have taken it on to build a brand new network that, first of all, connects all the major data centers in the country. And the second thing it does is provide dedicated fibre services to each tenancy in every building of the major CBDs and commercial areas in the Australian capital cities. And so what's exciting about this network is it will be the definitive fibre network in the country. If people want fast services between data centres to their offices in Australia, then the FibreconX network will be the most efficient, fastest, quickest, cost-effective network in the country. And so the partnership with FibreconX and Activeport is exciting because the best way to access the FibreconX network and deliver services across the top of it will be through the Activeport SaaS portal called Global Edge. And that for us will be, we hope, a significant source of new revenue. But to execute that well, we need to have more feet on the street. We need feet on the street in Sydney, in Melbourne, in Brisbane, in Perth. We need to be able to bring this service to the customers. We need to be able to convert customers away from the legacy networks onto this brand new FibreconX network. And we need to execute that process very, very well. We have announced it yesterday, as I said, and we're in the process of setting up the infrastructure and rolling out the software and configuring the interface to make it accessible to the users. And we need to get this done by Christmas. And so when people say, why are we back to the markets? Well, this project is a major driver of that, is we need to be able to fund the growth of the SaaS platform to meet the demand coming at us from the FibreconX relationship. We're extremely excited about it, but we need to focus down and do a very, very good job of execution. And so people will see a lot more in the market about this project. And we should see the results coming through in Q2 and Q3 of new revenue and new customers coming onto our SaaS platform, courtesy of the relationship with FibreconX. And so the rollout in Southeast Asia for the major telcos, the rollout in Australia for the SaaS platform with FibreconX is the main drivers of our working capital requirement. But of course, behind that, we need to continue to build our product. And if you think about what we're doing in product development, we're continuing to build new telco features for our licensed telco customers. We are seeing a raft of demand for new AI applications. And so we're taking our vertical solution in GPU orchestration for cloud gaming. We're adapting that to the AI industry. and we're finding more and more projects every week where customers are coming to us and asking us to be able to orchestrate AI applications on our telco networks and on GPUs deployed by our telco customers. So we're very excited about the new AI applications that we're building. We continue to evolve our game streaming engine to the extent that we think that this is probably the leading game streaming engine in the world right now. We have reference designs that we're delivering to our current partners that should see a 10x increase in performance across the GPUs that we're deploying to the now 84 telcos around the world. And so we've focused a lot of resource on optimizing the game streaming engine and enhancing the features there. We need to build new dark fiber access products to work with across our relationship with Fiber Connect. So this is a new build that we're working on. We continue to roll out new SaaS features across our global edge platform. And we're doing a lot of work on what we call OSS BSS integration, which is integrating our front-end services and our orchestration services with a telco's back office functions, whether it's the technical implementation service like service desk and ticketing, or whether it's a financial application like Oracle Financials, SAP. All of our telco customers need us to integrate to their specific flavors of OSS and BSS systems. And so as we bring more telco customers on board, we have a lot of development to be done in that space as well. And so our working capital from this equity round will be used across these three things: to roll out our software through Southeast Asia for this new telco customer, to roll out our SaaS platform in Australia to work well with Fiber Connects, and to build on our technical foundation and develop a raft of new features that will help us generate even more revenue. So think about our FY25 focus. First and foremost is recurring revenue. For the first 2 years of our existence, we had some great wins in telco around the world and data center operators. A lot of it was one-time revenue, which was fantastic. But what our investors want to see, what I want to see, is our recurring revenue get above our fixed costs, so that we're fully self-funded going forward. And so a real focus on FY25 is to just double down on our efforts to generate good, solid growth in recurring revenue. We're optimizing the balance sheet with a combination of equity and debt that we've talked about. We are working on a number of new global telco deployments. Southeast Asia is really the tip of the iceberg. We've already got a number of top telco operators in India using our product and planning to roll out more features. And we're working very hard in the Middle East to achieve a similar outcome and have our software adopted by some of the tier 1 telcos in the Middle East. And we've started conversations with some tier 2 telcos in North America as well. So we're very excited about our global telco deployments and the opportunities we've got in that market. Our Fiber Connects partnership is now first and foremost in our minds. We are working very, very hard to throw everything at that to get it up and running as quick as we can so that we can monetize that opportunity. And of course, we've talked about all the product development initiatives that we have. And so with that, I'll hand it over to Q&A, Lisa.
We don't have any questions at this time, Peter.
Excellent. Well, if anybody has any questions, please type in the Q&A box on the screen. But Lisa, if we don't have any questions, then that's it. Thank you, everybody, for attending. Appreciate your time.